Well, it is a pretty rare event. Only once every 210,000 blocks on the Bitcoin blockchain, of which, of course, there are many now. But let's spend a few minutes and talk about what the significance of this event is and what implications it might have for the value of Bitcoin and maybe the cryptocurrency ecosystem at large. There have been some reports, and some pundits have said that it may not matter at all. It may be a non-event. The price has already been baked in. The news has already been priced in, but I think I can convince you otherwise. But before I begin, I'd like to just make a quick public service announcement that when I talk about Bitcoin, I'm really referring to kind of this bi-metallic monetary system or a bi-crypto monetary system, including Bitcoin Core and Bitcoin Cash. So part one, we'll go into some of the details of the halving, few of the facts. So on block number 630,000, which for Bitcoin Cash will be in April and Bitcoin Core will happen around the middle of May, the reward per block for the miners will drop from 12.5 Bitcoins down to 6.25. It's important to note that as of that time, 87% of all Bitcoins that will ever be mined will have already been produced. That's a pretty significant factor to take into consideration when you're trying to determine the value of newly issued Bitcoin and pre-existing Bitcoins as well. So what that means is that after the halving, only 2% approximately of new Bitcoins will be produced relative to the pre-existing stock of Bitcoin. So the expansion of the monetary system, so to speak, will be downright tiny. By contrast, in 2017, there were about 6% expansion of the monetary system of Bitcoin. So the effect that had in 2017 to potentially oversimplify the matter was, the price expansion that we saw subsequent to the halving in late 2016, which, of course, was similar to what happened back in 2012 with the first Bitcoin halving. So we'll go from 1,800 Bitcoins a day to 900 Bitcoins a day, as you can see, and that will represent at current Bitcoin prices about $7.2 million of US dollars of Bitcoin mined per day. So historically, what we've observed is that there's a nonlinear relationship between the supply and demand fluctuations of Bitcoin and other cryptocurrencies and their equilibrium price. So there's no reason to believe that this halving will be any different in my humble opinion. For one example, we have new buyers that are entering the market every single day that didn't know about the halving before it happened and probably won't realize that it just occurred after the fact. Here's a chart that illustrates the new issuance or the monetary base expansion annually of Bitcoin. And you can see back to 2014, the expansion was almost 20%, which is pretty significant. 2017, as I mentioned before, was around 6%. Now we're down to virtually nothing, really. If you compare that to the US dollar, by contrast, it's about a quarter of the annual expansion of that monetary base. In order to analyze the effect of the halving on Bitcoin pricing and the Bitcoin ecosystem, it can be useful to go through some economic principles, albeit somewhat boring. But I'll go through this quickly so that we don't have to dwell on it too long. But first and foremost is this basic economic model between supply and demand, showing the equilibrium price. If you have a reduction in supply, or you have an increase in demand, or you have both, you'll have an increase in the equilibrium price. I think that's pretty straightforward. Most of us learned about that in our economics classes, even back to high school. There's another interesting valuation methodology called stock to flow. So stock to flow goes like this. There's a certain stock of gold or any commodity or any object or product that's used for money, and then there's an annual production. So there's a number of ounces of gold that are mined every year. There's a number of Bitcoins that are mined every year. So Bitcoin's stock to flow ratio before the halving is 23. After the halving jumps to 46, obviously. And if you compare it to some of these pre-existing forms of money and other precious metals and what have you, you can see that the higher the stock-to-flow ratio goes, the more attractive that asset becomes. We're still going through some of the economic stuff. This is a regression analysis that a very generous user on Medium with username 100 trillion USD put together to predict or essentially analyze the historical price action and relate it to the stock-to-flow ratio of Bitcoin over the past 10 years or so that Bitcoin has existed. And the color coding you can see on the right-hand y-axis, but essentially what this is telling us is that as the stock-to-flow ratio goes up of Bitcoin, so too is the price going up. And this is pretty important because, of course, it'll help us in a prediction of what might happen in the future. You can see this black line, which is the stock-to-flow model price prediction for the next 18 months or so. And it's a pretty exciting prediction. And just to make it clear to everybody in the audience, this is not just one person that's sort of out on the fringe. This regression analysis has been repeated in various different ways, and there's been a convergence in the result of all of these analyses. So it's looking pretty good. And you can take a look at the article if you want to on Medium there. Now, very quickly, there's a pretty well-established method for valuing money, and it boils down to SDDRFT. So these 6 characteristics, which all boil down essentially to the trustworthiness of money. And what we did a couple of years ago is we compared different forms of money against each other, which you can see here: cowrie shells, US dollars, Argentinian pesos, et cetera, et cetera. And what we felt was that Bitcoin actually scored higher than any of those. And so this is a stack bar chart that compares these various forms of money to each other. So you can kind of see empirically the value of this form of money, and this sort of factors into an analysis of what will happen after the halving to the value of Bitcoin to the general market. But then you have to ask yourself a question, like, these numbers are great, but what is really backing the value of Bitcoin? Like, why is it valuable to people, and what's really pushing it? And in our belief, it's this. It's neck tattoos. Neck tattoos are what are fundamentally backing the value of Bitcoin, because this is, without a doubt, the most blatant and obvious exhibit or manifestation of somebody's faith in the future value of this form of money. And it may seem a little humorous, but it really is true, because these people, and there are hundreds, if not thousands, of images across Google that show different people that have tattooed Bitcoin in various forms onto their bodies. And in fact, it's not new. People have been tattooing money on their bodies for, since time immemorial, as long as we've had money, perhaps. Going back to some of the economic principles, there's another one called the price elasticity of supply, which essentially means that for most goods and services, that if the price goes up due to a change in the demand side of the marketplace, new supply will come into the market. What's very interesting about Bitcoin is it's the first good that's ever been bought and sold, and I'll welcome anybody to give me another example that would fit this category, but the price elasticity of supply is actually negative, which means that as the price goes up, supply actually goes down. And that's one of the key contributing factors, the key driving forces to the extreme volatility that we've seen in the Bitcoin market for the last N number of years. This is one of the feedback loops, which is driven by the miners. The basic idea here is that miners have operating expenses that are all denominated in fiat money, regardless of what jurisdiction they may live in around the world. So if the price of Bitcoin, which is how they earn their revenue, goes down, they have to sell more Bitcoin, which accelerates the downward cycle. And of course, the reverse is also true. So if the price of Bitcoin starts to go up due to other factors, then the miners can hold more of their Bitcoins back, and therefore that accelerates the price on the upward side as well. Well, this is what it results in, essentially. Is an equilibrium that we just can't quite maintain because we really don't have any retro controls. We don't have anything attenuating the volatility. Okay, a little bit about me. I don't want to dwell on this too much, but I founded a relatively large crypto mining company in the United States that I took public in Canada back in 2018. Going further back, in 2013, I was helping to manage a private equity firm in the Bay Area, and that's when I started mining Bitcoin for the first time. And then after a couple of years of kind of doing it on the side, I decided in 2015 to start my own venture investment firm, in which I started making venture investments into the crypto space, and have been doing that ever since with a great deal of satisfaction. And many of the people at the show today I've collaborated with and had great experiences with. I'm an advisor to a couple of still existing crypto investment firms as well, but let's just keep moving on because I don't want to run out of time and hold this thing up. This is a couple of photographs of the crypto data center that we built in the United States. It's in Montana. And then moving on to HyperBlock. So you can see very quickly there's 5 business units within HyperBlock. HyperMines, which is the mining that we do. HyperBox, which is a modular sort of a shipping container based mining solution. We have HyperCloud, which is cloud mining sales that we do in collaboration with Bitcoin.com. And then we have HyperTrade and HyperLabs being our algorithmic trading desk, and our R&D lab, where we're looking to accelerate user adoption and customer acquisition for the Bitcoin ecosystem at large. That's a couple of details on the modular mining. If anybody is interested, we have a booth outside, of course, so please stop by and we'd be happy to talk to you. And then proprietary trading, same story goes there. If anybody's interested in collaborating on trading strategies or platforms or co-development, we're very interested. The HyperBlock software development team's based in Toronto, Canada. So let's keep moving. What about the Bitcoin miners? So mining revenue, as you can see here, has been in decline, and this is an illustration of the last halving back in the summer of 2016. So you can see that sort of in the middle of the chart. Now, what saved the miners at that time was that 16 nanometer mining servers came out, and the price was decreasing very rapidly. So many miners were able to stay in business at that time. But if you fast forward to more recently, with the big surge that we had in Bitcoin prices back in 2017, it drove an incredible overinvestment, in my opinion anyway, into mining equipment. You can see that $1.2 billion deficit here, which is still yet to be paid back. Now, let's see, we're a year and a half after the point when we made this chart. And so here's where we find ourselves today with 7 nanometer mining servers, which we don't have too much time to get into, but they're more power efficient, did come out many months ago, but they're not getting purchased in the kind of volumes that the previous generation were, and that's largely because many of the miners haven't paid back the investments that they made in the last generation. In addition to that, the fabrication, the silicone foundries are providing most of their wafers to the likes of Apple and other consumer electronics providers. So here's a quick comparison of the mining servers that are out there. You can see the old generation at the bottom. If the price of Bitcoin doesn't go up before the halving, then you can see that and there's millions of these running around the world. It's 65 exahashes. That's 65, we'll say for it. Okay, so quickly moving on. What are miners doing to prepare? Well, many are planning to discontinue their businesses. We are trying to, sort of evolve and grow and, kind of like disrupt ourselves. And this is a pretty exciting invention that we came up with about a year ago that I'd like to just spend a couple of seconds on. This is a solar hybrid data center. So we use solar power, we use battery power, and we use grid power. And with the software that we've produced to manage this thing, and with the way that we're integrating these modular data centers with the solar farms that we're building out, we're able to enjoy a power price that is less than 1.5 cents per kilowatt hour, which allows us, it is more expensive, of course, on the CapEx side to build these data centers out, but if you compare it to a traditional crypto data center, we're able to pay off the CapEx, the incremental CapEx of this type of model in less than 2 years, and then subsequently, we're able to earn an extra $300,000 per megawatt per year, which is a big deal because if you extrapolate that out to the 6,000 or so megawatts that are used for mining cryptocurrencies, it's quite a lot of money. And this isn't just applicable to cryptocurrency mining, it's also applicable to cloud computing, machine learning, artificial intelligence, and what have you. If anybody's interested in this, we'd be more than welcome to give you a demonstration of the prototype system, which we have built in Denver, Colorado. Anybody's welcome. You can stop by our booth or find me after the presentation today. And then finally, let's take a look at the conclusions. So first of all, as we talked about, we've got a virtual standstill on the expansion of the monetary base. That's good. Stock to flow model suggests that we're going to see great upward surge in pricing, which can't really be front run like stocks, releasing earnings or M&A announcements or what have you, because here what we've got is just an economic phenomenon where overnight, the supply of this commodity that everybody's been buying steadily, throughout the years is getting cut by half. There's no way to prepare for that, in my opinion, which is what I just described. And BCH, as I mentioned, will give us sort of a 3-week sneak preview at the BTC halving, which will take place in mid-May. We talked about the amplification. That's very important to keep in mind because as we see, and we have seen, price start to come back to life just over the past few weeks. And if that continues, you're going to see the miners of the world help to accentuate that movement, just like what we saw in 2017. We saw it twice in 2013. We saw it in 2011. You get the idea. We'll probably have sort of a culling of the herd, which ultimately is good because it pushes our technology forward. It forces us to do things like the solar modular data center that we designed and patented last year. And it's a good idea to just keep a look. You'll be able to, I posted these slides to SlideShare, and you can go onto my Twitter or you can go onto my LinkedIn and you can, download those and you can see all the resources that I've kind of gone through quickly today to get a sense of what metrics to keep your eye on as the halving comes and goes. And if you're interested in discussing any of these things, please, I do invite you to stop by our booth or talk to me personally, send me an email, what have you. We're happy to, discuss as many partnerships or if you have a project that you're looking for capital with, then please do let me know. And I just wanted to leave you with one final reminder of what we're all doing here, which is to kind of reinvent the money system in new and exciting ways for everybody that's buying and selling things around the world. It's a pretty exciting thing. Thank you so much.